Stop looking at candles and start seeing money. Why does the market always hit your stop loss and then immediately reverse in your favor? It's not bad luck. It's a perfectly engineered financial trap. In professional smart money trading, the market moves for only two reasons: to rebalance an inefficiency or to hunt liquidity. If you already know how to spot fair value gaps, today you will find the exact fuel that drives the price right into them. Liquidity is simply a massive pool of pending retail orders. Every time you buy, your stop loss is a sell order. When thousands of retail traders place their stops below obvious lows, it creates a giant pool of money. A massive bank wanting to buy $1 billion needs someone to sell it to them. Where do they find those sellers? Right at your stop loss. The market is a ruthless predator designed to collect those orders. Today, you will learn to stop being the prey. You will sit patiently alongside the predator. Understanding liquidity reveals the dark truth behind every violent market movement.
There are two fundamental concepts you must permanently burn into your trading brain: buy-side liquidity and sell-side liquidity. Buy-side liquidity, or BSL, always rests directly above previous historical highs. This specific zone is where retail short sellers place their stop losses and where emotional breakout traders leave their pending buy orders. If an institution needs to offload massive sell orders at premium prices, your buy stops provide the exact counterparty they require. Conversely, sell-side liquidity, or SSL, is trapped below previous historical lows. This is the resting place for retail buyers' stop losses. When an institution wants to accumulate long positions at a deep discount, they force the price down to trigger those stops, absorbing the panic selling. Your daily job on TradingView is to strictly mark these historical magnets: yesterday's highs, last week's lows, or London session extremes. The algorithm plays an endless game of financial ping pong. Once the market aggressively clears buy-side liquidity, the highest probability target shifts immediately to the sell-side liquidity on the opposing end. Stop guessing price direction. Just follow the trapped money.
The most dangerous illusion in retail technical analysis is the legendary double top or double bottom. Textbooks taught you these are unbreakable walls of support or resistance. For smart money algorithms, equal highs are nothing but an irresistible glowing target. In institutional terms, we call this engineered liquidity. When you spot two perfect peaks aligning on your TradingView chart, you are actually looking at an explosive concentration of stop losses piled just above that invisible ceiling. The algorithm purposely manufactures these artificial levels to bait retail traders into selling, feeding them a false sense of absolute security. The more the price bounces off this fake wall, the more retail money stacks behind it. It is a fragile dam begging to be shattered. Professional traders never trade the bounce off equal highs. They patiently wait to aggressively trade the brutal sweep that inevitably follows. This algorithmic sweep is lightning fast and violently destructive because double the money is waiting to be harvested. Where the retail masses see a solid wall, you must learn to see a highly profitable institutional target. Identifying a true liquidity sweep in real time requires a masterful understanding of the relationship between candle wicks and bodies. A sweep is not just the price blindly crossing a line, it is a calculated capture and rejection maneuver. When the price aggressively pierces a major historical high but completely fails to sustain that momentum, leaving a massive wick while the body closes firmly below the level, you are witnessing a live institutional stop hunt. That long wick is the exact fingerprint of the algorithm triggering buy stops and trapping breakout traders at the absolute worst price. Once the banks have collected enough retail fuel, they have zero interest in holding the price up there. The resulting rejection is violent and instantaneous. That rejection wick is your definitive confirmation that liquidity is neutralized and the trend is reversing. Professionals never enter blindly on the breakout. We wait to see if the candle body fails to close above the trap. Trust the body, not the wick. Money just transferred from impatient amateurs directly into institutional pockets. Get ready to trade.
Liquidity is not only about specific price levels, it is deeply tied to precise timing. Enter the Judas Swing, the single most devastating manipulation tactic in institutional trading. This engineered trap almost always occurs right at the opening bells of the London or New York sessions. The algorithm initiates a highly aggressive fake rally in the exact opposite direction of the day's true intended trend. Why? To brutally sweep the liquidity resting above the previous session's highs, and to lure greedy breakout traders onto the wrong side of the battlefield. If central banks want to push the market lower, they will initially pump the price up at the open. This triggers pending buy stops, giving institutions the necessary liquidity to fill their massive short positions. Once the banks are fully loaded, the price collapses violently. Retail traders are left holding catastrophic losses while the real expansion begins. Mark your midnight opening price. If you see an aggressive push above it, followed by a sudden structural break downward, you caught the Judas Swing. Have the patience to wait.
To navigate the charts like a high-level algorithmic trader, you must realize price is trapped in a never-ending cycle between external and internal liquidity. External liquidity lives at the absolute extremes of your dealing range, the daily or weekly highs and lows. Internal liquidity exists as the structural inefficiencies, specifically fair value gaps, left behind inside that very same range. The interbank delivery algorithm operates on a rigidly simple binary code. Once it sweeps external liquidity at a major high, its immediate objective is to crash inward and rebalance an internal inefficiency. Once that internal fair value gap is completely filled, the algorithm reloads and launches outward to attack the external liquidity on the opposite side. It is a flawless, infinite algorithmic pendulum. When you witness a major high being swept, stop looking for higher targets. Immediately locate the nearest internal FVG. Price will magnetize back to that void to collect orders before continuing its journey. This cycle gives you the ultimate roadmap for precision take-profit targets. You will always know exactly where the market is going next.
Now that you comprehend the dark psychology of the algorithm, you must apply this on your TradingView charts. Your non-negotiable morning routine is to map out the highest probability liquidity targets, known as the draw on liquidity. Begin on the daily time frame. Methodically mark yesterday's high and low, labeling them PDH and PDL. These are your premier external liquidity magnets. Next, drop down to the 15-minute time frame and scan ruthlessly for engineered retail traps, the equal highs and equal lows. Never execute a trade in the random middle of a range. You must sit on your hands and wait for the algorithm to push the price directly into your predetermined lines. Watch the exact behavior at these kill zones. Does the price pierce the level and immediately reject with a long wick? That is your sweep confirmation. Mapping your liquidity transforms your chart from a chaotic mess into a high-precision GPS tracking system. Train your eyes to spot the hidden pools of money before the candles even form. Institutional execution demands flawless preparation and cold discipline.
The vast majority of retail traders feel personally attacked when the market hunts their stop loss, but in reality, it is simply a mandatory mechanism of algorithmic risk transfer. The institutions literally require your failure to fuel their entries. When your stop loss triggers, it instantly morphs into a market order, providing the exact liquidity banks need to execute massive positions without slippage. Stop placing your protective stops at obvious retail support levels. You must learn to place your targeted entries precisely where the retail masses place their exits. Congratulations, you have officially unmasked the true engine driving the global financial markets. You can now identify buy-side and sell-side liquidity, expose the deadly trap of engineered equal highs, and exploit the manipulation of the Judas Swing. You now hold the two ultimate weapons of smart money concepts: the fair value gap, the algorithm's footprint, and liquidity, its explosive fuel. In the next episode of this masterclass, we will fuse these two powerful concepts together to forge the master setup. I will reveal the exact mechanical step-by-step entry model you need to execute trades with institutional precision. Subscribe right now and turn on notifications. It is time to stop being the market's fuel and start pulling the trigger like an elite institutional operator. See you there.